So, stock markets all over the world are taking a hit. You see the charts flashing red, and yeah, it's making a lot of people nervous. But what if I told you the real story isn't what's happening on the surface? What if there's a much deeper signal, kind of hidden, that could tell us a lot more about where we're actually heading? Okay, let's get into it.
We're seeing big drops in major markets like the Nikkei, and it feels a little different this time. The real question we have to ask is why? Is this just another market dip, business as usual, or is something more fundamental changing right under our feet? To figure that out, we need to put on our detective hats and look somewhere else.
All right, so our first big clue, it comes from a place a lot of stock investors don't really pay attention to, the high yield bond market. We're going to zoom in on this one ETF, ticker symbol HYG. People in the know call it the canary in the coal mine for the economy. And right now, well, that canary is starting to look a little shaky.
So, what is this HYG thing anyway? The simplest way to think about it is as a big basket of bonds from companies that are, let's say, a bit riskier. And because there's a higher chance they might not pay the money back, they have to offer a bigger reward, a high yield, to get people to lend the money. It's basically a thermometer for how much risk the market is willing to take. And here's what that thermometer has been doing. Now, what's really important here isn't the size of the drop, it's actually still pretty small. The real story is the pattern. We've got 4 straight weeks of declines. It's a quiet but really clear signal that the overall mood is shifting from let's go to uh-oh, let's be careful. But, just looking at the price doesn't give you the whole picture. The signal the real pros are watching, the more precise one, is something called the credit spread. This is basically the extra amount of interest investors demand for holding these riskier bonds instead of super safe government bonds. And that spread has been telling a very interesting story lately. In just the last 2 months, that spread has jumped by 57 basis points. Now, that might not sound like a lot, but in the world of bonds, trust me, that's a significant move in a really short time. It means investors are suddenly demanding way more compensation for taking on risk. They're getting worried about whether these companies can actually pay their bills. Okay, so why should you, a stock market investor, care about any of this bond stuff? Well, this brings us to a super important idea. Think of it as a tale of two mindsets, the cautious banker versus the optimistic investor. On one hand, you've got the credit market, our banker. The banker has one main question, and one question only. Can this company survive and pay me back? Their whole world is about durability. On the other hand, you have the stock market, our investor. The investor is asking a totally different question. How big can this company get? What's the dream? Their world is all about possibility. And this is exactly why the bond market can be like a crystal ball. The banker gets worried first. When the entire conversation shifts from how much can we grow to can we even survive, you see it in the credit spreads way before you see it in the stock prices. The banker is the first to get nervous. So if our cautious banker is getting nervous, what exactly is it so worried about? What's the prime suspect behind this whole mood shift? Well, all the clues we've gathered, the stock market drop, those widening credit spreads, they're all pointing to one particularly nasty economic villain. And that villain's name is stagflation. It's a word that gives economists nightmares. And for good reason. It's truly the worst of both worlds. The economy is stuck in the mud, it's not growing, so companies and people are struggling. But at the exact same time, prices for everything just keep going up. So why is it so scary? Because it puts the people in charge in a totally impossible position. Think about it. To fight slow growth, you need to hit the gas, right? Lower interest rates, get things moving. But to fight high inflation, you have to slam on the brakes, raise interest rates. Trying to do both at once, it's like the system just seizes up, it's paralyzed. And that is exactly the dilemma central banks are facing right now. They are completely stuck between a rock and a hard place. Any move they make to fix one problem just makes the other problem worse. There are no easy answers here, and that uncertainty is exactly what's making the markets so nervous. Now, look, this isn't just some scary theory we're talking about. We are actually starting to see this stagflation story pop up in the real, hard economic data. The numbers are beginning to back it up. First, let's look at the stag part, the stagnation. U.S. GDP growth for the fourth quarter got revised way down to just 0.7% on an annualized basis. That is a major slowdown. It's a clear sign the economic engine is losing steam.
And then at the very same time, you've got the inflation part. Core PCE inflation, which is the one the Federal Reserve watches most closely, is still stuck up at 3.1%, way higher than their 2% goal. So you see the problem, right? Slow growth, high inflation, happening at the same time. The data confirms the risk is real.
So, with this really tricky environment, what should we be watching? What are the key things that are going to tell us how this story plays out from here? Here's a quick and simple watch list to help you keep investigating on your own. First, keep a close eye on those high-yield spreads we talked about. Are they widening faster? Second, watch what companies say about the future during earnings season. Are a lot of them lowering their forecasts? Third, obviously track the official inflation numbers and listen very carefully to the language the central bankers use. And finally, watch the relationship between the price of oil and interest rates, because energy prices can be a huge driver of this whole thing.
And that really brings us to the final big question. We've seen how the market's entire focus is shifting, away from the optimistic investor's dream of possibility and toward the cautious banker's reality of durability. So the question for all of us now is, which companies, which industries, and even which countries actually have the durability to pass this stress test? That's what the market is trying to figure out as we speak.